All right, good afternoon, and welcome back to the Broken Business Models podcast. We're your hosts, James and Ryan. And before we get into today's podcast, just a quick disclaimer how we start all of our podcasts. Nothing in this podcast or any of our other materials should be taken as investment advice. You should always do your own work, consult a professional before making any investment decision. We're going to be talking about some individual stocks, some very volatile stocks that we could have a position in and change our positions at any time without notice. So just make sure to do your own work and consult a professional before making any investment decision. With that being said, today we're going to be talking about the Bitcoin mining stocks. So in the past few months, there's been a lot of positive sentiment around Bitcoin and crypto in general, and the Bitcoin miners in particular, with a lot of positive price action in the publicly traded stocks. A few months ago, we put out a video on the main channel where we talked a bit about why Bitcoin mining as a business is a very difficult business and has several inherent challenges to it. But today we're going to be talking about a little bit about some specific Bitcoin stocks that are publicly traded that seem especially divorced from their fundamentals in terms of their price action. So with that, I'll hand it over to you, James, to talk about the specific stocks.
Yeah, so today we're going to talk about a few publicly traded Bitcoin mining stocks, and all of them have seen their share prices increase massively this year as the price of Bitcoin has increased. And obviously, investors are very excited about the mining stocks, given that the Bitcoin price itself has increased. But we'll do a deep dive into the business models of these companies to see whether this increase in share price is really warranted. So as a quick refresher, how it works for how the Bitcoin mining business model works. So you buy the mining rig, and then you supply it with electricity to power it, and then you create Bitcoins with that. And there's a few factors that will impact how profitable your operation is. The first one is, what is the cost of the mining rig? That's money you have to put up front. And then how long are you able to use the mining rig? So the depreciation of it. And then you have to look at what is the cost of electricity. And then on the revenue side, you have to look at, what is the price of a Bitcoin? If you're measuring your revenue in US dollars, what is the price of a Bitcoin will obviously impact your revenue. And then also the difficulty rate, how competitive is the market, which will impact how many Bitcoins you are able to mine. And the key thing to understand with Bitcoin mining is that the vast majority of the revenue for the miners, well over 90%, comes from the block rewards. The remainder is, they also make some transaction fees, but those are relatively minuscule. The vast majority is the block rewards. And the block rewards, that is the source of how new Bitcoins are created. They're distributed to the miners basically, and there is a fixed amount of Bitcoins that are mined each day, and all the miners all over the world have to compete for that fixed supply each day. And every 4 years, there's a halving event where these block rewards are cut in half. And then if you look at a chart of the total circulating supply of Bitcoin, it's a concave function where in the beginning it was increasing very fast, and then it starts increasing more and more slowly with each halving event. So every time there's a halving event, it makes it more difficult for the miners because there's a smaller pool of block rewards that they're all competing for. And then the other side of the equation is the competitiveness of the network. So because there's a fixed supply of Bitcoin to be mined each day, the more miners there are in the world, the more difficult it is for any one miner to get that Bitcoin because there's so much competition. And we can see that the computing power that's used in mining, it's called hash rate. And this chart here shows the total deployed hash rate of all the Bitcoin miners in the entire world. And it's been, increasing massively in the past few years. This dip here, this is when China banned Bitcoin mining. So that caused a temporary dip, but that was very quickly compensated by miners in the rest of the world. The reason why the global hash rate is increasing so rapidly is because the companies that make the mining rigs, every year or two, they'll release a new rig which is more energy efficient than the previous one. And the more energy efficient, because the main cost of operating it is electricity, the more efficient it is, the more profitable it'll be to run, and then the more people want to buy it, and then so the total supply of Bitcoin miners increases, making it more competitive. So that's basically the story, is that the Bitcoin mining network is always getting more and more competitive because the mining rigs, the machines, they become more efficient. And a big issue with this is that, for the miners, is that as the mining rigs become more efficient, the old rigs become obsolete. And when you have, say, you buy a mining rig, and then that rig will, generate you, X number of Bitcoin per month. Well, as the difficulty rate increases, right, as the competitiveness increases, the amount of Bitcoins per month you'll be generating is decreasing over time. But your cost of powering your rig with electricity remains constant. And at some point, the amount of Bitcoin that you're generating is going to be less than your electricity cost, at which point the mining rig effectively becomes useless. Um, and that's and because the global hash rate is increasing so rapidly, mining rigs and new models of mining rigs are coming out so frequently. Old mining rigs become obsolete very quickly. And if we look at, these are three of the biggest publicly traded mining companies in the US, Riot, Marathon, and CleanSpark. They recognize depreciation on their mining rigs based on an estimated useful life of 2 years, 3 years, and 3 to 5 years. So these things, within 2 to 5 years, you have to basically replace all of your mining rigs because they've become obsolete. And that's obviously a huge expense. And mostly because of this massive expense of always having to depreciate and then replace your mining rigs, almost none of the publicly traded Bitcoin miners have ever turned a profit. So here is the revenue of these, top 3 Bitcoin miners in the US, and then here is the operating profit. And despite the fact that they're generating, very large amounts of revenue. In fact, all of them in 2023 are generating well over $100 million of revenue. They're all losing money. And it's not just because of the recent, crypto winter we had in 2022. Even if you look back in 2021, when the average Bitcoin price was above $45,000, all 3 of these Bitcoin miners still lost money. So even when Bitcoin was surging, it should have been the best time ever to be a Bitcoin miner. They all still lost money. And it's because of the massive depreciation expense of the mining rigs. So for the rest of this video, we'll focus mostly on CleanSpark. The reason being, we can't look at every single one of these companies in detail, because then this video would take more than an hour, and they're quite similar. They all pretty much do the same thing. So there's not that much value in looking at every one individually. So we're just going to look at CleanSpark, which is a particularly interesting one because, the revenue has grown very rapidly. So in 2021, they made less than $45 million worth of Bitcoin. In 2022, that's increased to more than 100. And then this year, in 2023, they made more than $150 million of Bitcoin revenue. So because it's been growing so fast, it's gained a lot of attention from investors. So that's kind of the one we'll focus on for the rest of this video. But to be honest, they're all pretty similar. They all pretty much do the same thing and have similar economics. Now, with CleanSpark and basically all of the Bitcoin mining companies, they'll put out their investor presentations where they'll brag about their very high gross margins. So in the fiscal year of 2023, for CleanSpark, which was the 12 months ended September 30th, they had a gross profit margin of 44%. And that sounds very good. The problem is this gross profit margin, it does not include depreciation. And depreciation is the main expense. It's the largest expense for the Bitcoin miners, but the gross profit excludes that. It only looks at the direct, cash operating costs of the electricity and like the rent of the facilities, etc. They do not include depreciation. But when you have to replace all of your mining rigs every 3 to 5 years, that's a huge expense, and that is something you need to take into account. But when they talk about the gross margin, it does not take that into account. So it's based, the fact that they're making a very high gross margin is kind of a red herring, and it doesn't give you a complete picture into the the real profitability of the business. And to get a sense of what I was talking about earlier with how the difficulty rate is constantly increasing, this chart shows CleanSpark's monthly Bitcoin production. That's the blue bars, as well as their deployed hash rates in the orange bars. Um, they're all drawn to scale, but don't pay too much attention to the actual numbers on the axes, because I had to like adjust the axes to make them all fit on the same chart and be visible. So don't worry about the actual numbers. Just basically look at the bars and the line. So the Bitcoin, so over the past couple of years, they've been growing massively, buying new Bitcoin mining rigs and increasing their hash rate, and that is this orange bar. It's been increasing quite massively, and as their hash rate is increased, you would also expect that their amounts of Bitcoin that they've mined, which is the blue bars, are also increasing, which looks good. The problem is the blue bars are increasing at a much slower rate than the orange bars, and that is because the difficulty rate is increasing. So the black line going down from the top left to the bottom right, that is the Bitcoins mined divided by their deployed hash rate. And so that's like the efficiency of, how many Bitcoins do I mine for a given hash rate that I have. And that number has been decreasing massively in the past couple of years. It's fallen more than in half. And if you do the calculations, the rate of decrease of this black line is decreasing at a rate of 4% per month. So if you buy one uh, Bitcoin mining rig and you start operating it, uh, it will generate 4% less Bitcoin each month than it did the previous month, because each month on average, the entire Bitcoin mining network globally gets 4% more competitive. So there's this 4% monthly decline rate, which is very important to keep note of. And obviously the Bitcoin miners are very expensive. So CleanSpark and all the other mining companies, they spend hundreds and hundreds of millions of dollars buying all of these mining rigs and setting up buildings and facilities and electrical lines to power it and everything. So it's hugely capital intensive. They all spend hundreds and hundreds of millions of dollars building out these mining rigs. And the question from an investor's perspective is, are they getting an acceptable return on investment for setting up their Bitcoin mining operations? And we can do some sort of back of the envelope calculations to see what are the how do the economics look for CleanSpark in particular. So CleanSpark began mining Bitcoins in 2020. Between 2020, from when they started to today, so it's been about 3 years, they have cumulatively burned 67 million or $670 million of negative free cash flow. So in the past 3 years, they've burned $670 million. So what did they get in return for that? So they currently have on their balance sheet 2,300 Bitcoins, and that's worth about $88 million at today's market prices. over the years, they've mined a lot more Bitcoin than this, but most of their Bitcoins they've sold to invest in new mining rigs. But currently, they only have 2,300 Bitcoin. And then they also obviously they have their current operations, all of the mining rigs that they have operating. Um, and that's they currently have 10 exahash per second of capacity. Exahash per second is just a unit of measurement of hash rates. So this is all of their currently deployed operations. Bitcoin mining operations is 10 exahash per second. They also have $76 million of deposits on mining equipment that has not yet been delivered. Now, if we take this 670, we subtract the value of the Bitcoin they own, we subtract, this mining equipment that they've already paid for, but has not yet been delivered. This 670 goes down to 500 million. So $500 million is money that they've actually spent, that they've already spent, and it's excluding their Bitcoin holdings. So they effectively spent $500 million over the past 3 years, and in return they have built up a deployed hash rate of 10 exahash. Now, is this a good trade? Is it worth it to spend $500 million to get 10 exahash? Well, let's see. So this chart here is a Bitcoin mining projection. And this is how many Bitcoins 10 exahash will create, how many Bitcoins you'll generate per month with 10 exahash. So in October of 2023, they mined a little over 600 Bitcoins, and that's with their 10 exahash of capacity. But that number decreases at a rate of 4% per month. As we talked about, the 4% decline rate based on the network always becoming more and more competitive. Then in April of 2024, there's the halving event. So then the size of the block reward is cut in half. So basically, CleanSpark's revenue gets cut in half overnight. And then from there, it continues to decline at a 3%, at a 4% per month rate. And this is for the next 3 years. And I use 3 years because that's about the useful life of their mining rigs. If you go any further than that, they're just it's unlikely that the Bitcoins they mine would even cover their electricity cost. But let's just say, you operate it for the next 3 years, which is the estimated useful life of the mining rigs. You would generate 6,600 Bitcoins approximately, based on this projection. But not only that, we don't. So how much does it exactly cost them to get these 6,600 Bitcoins over the next 3 years? Well, we talked about it cost them $500 million to build up their operations to what they are today. But in addition, they're going to have ongoing operating costs over these 3 years. So in the previous quarter, they spent $30 million on electricity and $25 million on corporate overhead. So that's $55 million per quarter. So if we multiply that $55 million per quarter over the next 3 years, well, they incur another $660 million of expenses over the next 3 years. And this is excluding depreciation. So they've already spent $500 million to get to where they are today. Over the next 3 years, they would spend another $660 million. So that brings up the total cost to $1.16 billion. And they're going to get in return for that 6,600 Bitcoins. And if you divide these two numbers, you'll get a total cost of $176,000 per Bitcoin. The price of Bitcoin today, it's about $38,000. So this is an extremely inefficient operation. They spend so much money to build and operate these rigs, and they depreciate so fast that they're always spending more and more money to operate these rigs. And so when you keep track of everything, look at all the money that they've spent and their current rates of corporate overhead and electricity cost, it costs them such a huge amount of money to mine each Bitcoin that if you're really bullish on Bitcoin, you'd be much better off just buying a Bitcoin yourself directly, because you can buy a Bitcoin yourself for $38,000, or you can invest into CleanSpark and it costs them $176,000 effectively to mine a Bitcoin. So it's an extremely inefficient operation, and it destroys a huge amount of value because their cost, their cost is so much greater than the actual value of Bitcoin. But one thing they are very successful at selling is their own stock. So this is a chart of their shares outstanding. So in 2020, when they first started Bitcoin mining, they had about a little under 20 million shares. They do, huge amounts of equity raises. At the end of fiscal 2023, which is, September 30th of this year, they had 160 million shares outstanding. So over the course of 3 years, they increased their share count by 8-fold. And that is how they've been able to sustain their operations. Because as we've shown, in the previous charts, they have always lost money. Even in 2021, when Bitcoin was reaching all-time highs, they still made an operating loss. Okay, they always lose money, but they're able to tell investors, hey, look, they're able to distract investors by saying, oh, look, we have positive gross margins, we have positive adjusted EBITDA. But these are all BS metrics because they don't include depreciation, which is a huge expense. And so in reality, they're extremely unprofitable and destroying value. But because investors don't understand that depreciation is a real expense that you need to take into consideration, they think that CleanSpark is actually doing well and they're willing to buy shares in the company. And therefore, the company is able to sustain itself by issuing more and more shares, even though the core business is losing money and would not be viable otherwise.
What if, as an investor, what if you're super, super bullish on Bitcoin? Like, what if you think that Bitcoin will like double or triple in the next year? Then would it, like, how bullish do you have to be on Bitcoin for it to make sense to buy a CleanSpark?
Well, there's a couple of things you have to consider. For one is if the price of Bitcoin does increase massively, we looked at, a 4% monthly decline rate. So we calculated the 4% monthly decline rate based on CleanSpark's numbers, and that goes from October of 2021 to October of 2023. So I think, Bitcoin peaked at some point in 2021, I think late 2021, but then 2022 was a really bad year for Bitcoin, right? And you would obviously, if the price of Bitcoin is increasing, all else equal, the Bitcoin miners are going to have a greater incentive to expand their operations and buy more mining rigs. So, if anything, this like 4% decline rate would accelerate if the price of Bitcoin increases massively. Because if the price of Bitcoin increases, then all of the miners will start buying up rigs very quickly, and that will accelerate the difficulty rate. So that's one thing to consider, which it's hard to quantify exactly. But one thing I would point to is, if you say you're a Bitcoin bull and you think that Bitcoin will surge massively, well, we already know what happens in that case because that already happened in 2021. In 2021, the price of Bitcoin absolutely skyrocketed, well beyond almost anybody's expectations. So it's the best possible situation you would think for the Bitcoin miners. And yet they still all lost money. It's because the depreciation is such a huge expense that it's hard to see how they would make money. And as we talked about here, based on these numbers, right? So I was talking about how the rate of difficulty rate would accelerate if the price of Bitcoin skyrockets. But even if we don't consider that and we still stick with the 4% monthly decline rate, well, I still calculated $176,000 per Bitcoin. And that's just for them to, break even on all the money they spent in total. But if you were to just buy a Bitcoin, well, then you just bought it for $38,000. And if it increased in price to $176,000, well, you've just increased your money fourfold, right? But if the price of Bitcoin skyrocketed to $176,000, CleanSpark would just break even. So you'd be much better off just buying the Bitcoin directly yourself if you thought the price would increase.
So it's not just a matter of how bullish are you on Bitcoin. It's like either way, there's headwinds. Bitcoin stays the same, they continue losing money. Bitcoin skyrockets, then there's even more competition, and Bitcoin goes down. Obviously, they lose money on each Bitcoin they mine.
Yeah, and I mean, that's not to say, because I don't know exactly what that kind of rate of correlation is with like the price of Bitcoin and the difficulty rate. Like, I don't know how quickly the difficulty rates will respond, but I think kind of the more important thing is I don't see any justification for buying the Bitcoin mining stocks, no matter how bullish you are on Bitcoin, because it's so much cheaper to just buy a Bitcoin yourself directly, because these miners are so inefficient in terms of the total amount of money they have to spend to mine each Bitcoin.
It'll be interesting to see how long these companies can last.
Yeah, I mean, as we've shown, they've lasted. Basically, the only reason they've been able to last as long as they are is because of their massive share issuances. There are still investors who believe in these companies and are willing to continue buying their shares. They raise hundreds and hundreds of millions of dollars through these share issuances, but at some point, I mean, I guess it'll take a break in psychology. People just need to wake up and realize what's going on here, and that their money's basically just being burned.
Yeah.
All right, I think that about wraps it up for everything we had to say about Bitcoin miners. As always, if anybody in the audience has any of their own opinions, or anything they disagree on, or thinks should be brought up, please let us know in the comments section below. And as always, thank you so much for watching, and we will see you on the next one.